Today, we're diving into Spirit Aerosystems Holdings, a really critical manufacturer in the aerospace world. Most people know them as the main producer of the Boeing 737 fuselage. And lately, they've been in the news not just for what they make, but for some pretty profound operational issues and, frankly, a resulting financial crisis.
Right. Spirit Aerosystems it's a really unusual situation, isn't it? You've got a company with assets that are, you could argue, strategically irreplaceable, but whose actual operations seem to have become, well, functionally insolvent.
Exactly. And that brings us right to the core question today. How should we actually value Spirit Aerosystems? I mean, given its really severe financial fragility, should we be looking primarily at its deeply negative intrinsic financial metrics? Or should the valuation be driven more by the, let's say, the strategic premium and the relative certainty baked into this imminent acquisition price being offered by its biggest customer, Boeing? My take is that the announced acquisition effectively sets a floor here, making those historical losses somewhat secondary to the strategic need for these assets.
I'm going to take the opposing view on this one, because while, sure, the stock price is clearly reacting to the M&A news, I think any rigorous analysis has to start with the fact that the company's valuations should be defined by its severe structural financial distress and its operational risks. You know, the current price feels more like a bet on a rescue mission, not really a reflection of a fundamentally healthy business.
Okay, let's unpack the strategic angle first, because that's really central to my position. The main driver, as I see it, is the confirmed acquisition by Boeing. Now, this is an all-stock deal valued at about $4.7 billion in equity. But crucially, when you factor in all the debt and the other obligations that Boeing is going to have to assume, the enterprise value jumps significantly to $8.34 billion. This isn't just a standard corporate deal. It feels much more like an act of vertical integration driven purely by necessity. And that valuation, I think, fundamentally validates Spirit Aerosystems' strategic, almost irreplaceable position in the whole aerospace ecosystem.
Calling it strategic necessity kind of glosses over the fact that Boeing is essentially forced into buying a massive liability, one that, let's be honest, its own supplier relationship management and quality control problems helped create or at least worsen.
That's perhaps a fair point on the history, but the market seems to be looking past those current liabilities, focusing instead on the future control Boeing gains. I mean, look, the company currently trades at a remarkably low price-to-sales ratio, just 0.66. That really reflects how discounted its revenue stream is right now compared to, historical levels. Now, we absolutely have to acknowledge the financial mess. The trailing 12 months EPS is a frankly shocking negative $22.11. But the forward-looking metrics, they tell a very different story. The forward PE ratio is projected at 42.59. That represents an extraordinary turnaround, like 108.77% growth expectation. And it's pretty much entirely based on a successful integration post-acquisition.
That anticipated profitability you mentioned, it feels purely speculative to me and completely hinges on the merger going off without a hitch. The core financials, well, they paint a picture of a company where basic manufacturing economics have just broken down. The trailing 12 months income shows a monumental loss, negative $2.6 billion. And when you dig into the operating efficiency metrics, honestly, the numbers are quite alarming. Gross margin is negative 26.68%. Operating margin, negative 33.86%. And the profit margin sits way down at negative 40.65%. These aren't just, minor accounting adjustments. They seem to reflect really deep structural flaws in the company's cost base and how it accounts for its major programs.
Okay, but doesn't the sheer scale of those negative numbers just underline why a fundamental change, meaning the acquisition, is really the only viable way forward, the only path to actually realizing the company's underlying technological value?
It underscores the risk, I'd argue. The depth of this financial decay is really evident when you look at its liquidity constraints. The quick ratio is just 0.46, the current ratio 0.68. I mean, for a major manufacturer like this, having ratios well below 1 signals a really severe inability to cover its short-term debts with easily accessible assets. On top of that, The balance sheet actually confirms negative total equity as of 2023. And if you do a deeper dive into financial strength, you find a very distressed Piotroski F-score of just 1.
Right. You brought up that F-score of 1. That does signal extreme financial weakness. Just for context, what does that level of distress really imply about the company's ability to survive on its own?
Well, it signals profound fragility and extremely high risk. The Piotroski F-score, it's specifically designed to pick up severe accounting problems or deep structural financial weakness. So getting a score of 1 in a major aerospace supplier like this, it absolutely confirms the going concern risk that actually management itself had to raise. And when we apply, rigorous fundamental models, specifically looking at free cash flow, one particular discounted cash flow calculation resulted in an intrinsic value that was significantly negative, like negative $84.52 per share. So the current stock price, in my view, exists almost purely as a price floor set by that M&A agreement, not because of any inherent self-sustaining operational health.
Okay. Let's tackle that tension directly. The negative intrinsic value versus the M&A premium. You're essentially arguing the acquisition is just a bailout, right?
It is. Boeing is effectively being forced to buy a business that has shown, repeatedly, it just cannot operate profitably on its own. It needed extraordinary measures like those big advance payments from both Boeing and Airbus just to keep the production lines from grinding to a halt. So yeah, this acquisition reflects massive existing losses and, frankly, expected future losses too, especially on crucial high-volume programs like the 737 MAX fuselage.
I'd challenge the word bailout, though. I think the acquisition actually confirms the strategic necessity. It confirms the irreplaceable, high barrier to entry nature of these assets. Spirit Aerosystems has valuable know-how, especially in composite manufacturing, which is absolutely vital for next-gen aircraft. You can't just easily replicate their tooling, their factories, or their specialized workforce overnight. The market, I believe, is pricing in the near certainty that this asset will be integrated and eventually stabilized. That $8.34 billion enterprise value, it explicitly accounts for the high debt because Boeing is willing to pay a premium for control, specifically control over quality and control to mitigate that externalized production risk that led to some very high-profile safety incidents recently.
Internalizing a dysfunctional operation is certainly a strategy, I'll grant you that, but it's one that is absolutely packed with integration risk. And that brings us to what I think is maybe the most overlooked risk here. The sheer complexity of this dual-party divestiture that has to happen.
Well, hang on. From Boeing's perspective, the acquisition primarily resolves that supplier strain, right? It simplifies their core 737 supply chain, which, as you know, accounts for nearly half of Spirit Aerosystems' revenue right now. This feels like a very targeted move to fix the quality problems, particularly in Wichita and Tulsa, and bring that absolutely critical aerostructure manufacturing back under the main OEM's roof.
That's the best case scenario, yes, but the execution risk is just immense. This transaction is extraordinarily complex, precisely because Spirit Aerosystems isn't just a Boeing supplier. It's deeply, deeply interwoven with Airbus operations all over the globe. So to get regulatory approval, and remember, we're talking about conditional EU clearance and a second request from the FTC here, Spirit Aerosystems has to go through this massive structural breakup. It involves transferring key Airbus assets. Think about the A350 sections made in Kinston and St. Nazaire, plus A20 components from places like Belfast and Casablanca directly to Airbus.
Right, but isn't that transfer to Airbus basically a condition designed to smooth things over? To resolve the antitrust concerns and actually streamline the whole process?
In theory, yes. But in practice, it introduces massive logistical and financial execution risk into the timeline, which they're currently aiming for, Q3 2025? Look, we're talking about transferring entire industrial facilities, specialized tools, probably proprietary IP, and thousands of skilled workers across multiple continents. And all of that is subject to various closing conditions happening while Boeing is simultaneously trying to integrate its own critical North American plants back into its fold. This kind of complex, multi-party divestiture creates a highly volatile, almost chaotic environment. It dramatically increases the chances of delays, cost blowouts, and probably production slowdowns right during the transition. And any hiccup there immediately impacts Boeing's own crucial delivery schedules.
Okay, so ultimately the outlook for profitability does hinge on navigating that execution risk successfully. But the consolidation itself, finally eliminating those decades of, let's face it, often adversarial friction between Boeing and its most critical supplier, that is the single biggest catalyst for achieving operational harmony, isn't it? That's the stabilization that supports those potentially higher intrinsic values. For instance, the DCF model I mentioned earlier, the one yielding around $48 per share. It relies entirely on a fundamental assumption of normalized future cash flows, meaning it assumes the elimination of this current crisis environment. Without the merger, the negative valuation probably holds. With the merger, the long-term asset value gets unlocked.
I have to challenge the underlying assumptions in that more optimistic DCF model, though. The trading data itself suggests there's quite a bit of institutional skepticism about this merger completing smoothly. The short interest is high, you've got a short float of nearly 11% and a short ratio over 13. That level of shorting, it signals that some pretty big investors are betting heavily against the stability or the timely execution of this really complex deal, not just betting against the old failing business model. And furthermore, recent reports confirm the pressure is still on. Analysts noted Spirit Aerosystems missed Q3 EPS estimates partly due to, and I quote, higher charges and lower program margins on Boeing programs, so the bleeding hasn't stopped.
But look, you're focusing mainly on the short-term pain there. You could argue the negative results in those forward loss provisions were at least partly necessary. Necessary to sort of clear the deck of historical liabilities and maybe some inefficient contracts before the merger happens. We should also look at tangible operational metrics like the company's quarter-over-quarter sales, which were actually up 7.81%. That shows that even amid all the financial turmoil, the fundamental manufacturing engine is still churning out product and revenue is growing. The consolidation really is the key to achieving that projected stabilization. And the analyst consensus price target, around $38.80, reflects a pretty broad belief in a successful transition and eventually realizing the company's inherent technological and industrial value.
Analyst targets in M&A situations often just end up mirroring the transaction price itself, don't they? It can become a bit of a self-fulfilling prophecy. Until that integration is actually complete, until the costs are demonstrably under control, and critically, until that negative equity is reversed, this stock remains, in my view, a highly leveraged, very speculative bet. It's valued purely on the probability of one single complex event happening, and it's standing on a foundation of real structural financial weakness.
Okay, so to quickly summarize my position, Spirit Aerosystems is fundamentally an irreplaceable strategic asset. Its future value right now is primarily defined by that $4.7 billion acquisition agreement with Boeing. This deal is the mechanism to resolve the company's severe liquidity and quality problems through vertical integration, which ultimately ensures the continued viability of something as crucial as the 737 program. Therefore, I believe the analysis has to focus on the high probability of the transaction closing and the operational stability that it promises once Spirit is under Boeing's full control.
And conversely, my summary is that Spirit Aerosystems remains, as we speak today, a deeply distressed operation. It has negative equity, it's racking up massive losses, and there's significant short interest signaling real market skepticism. The acquisition process itself is fraught with complex regulatory hurdles and, I think, extraordinary logistical risks tied to that dual-party divestiture involving Airbus's global assets. So the current stock valuation feels less like a reflection of sound underlying financial health and more like a highly speculative leveraged bet on the flawless completion of one very complex event, the merger itself.